From New York City for viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, bond vigilantes return with a vengeance, sending U.S. yields on the long end to multi-year highs. This follows the Fed's decision to hold rates steady without offering a clear read on the path forward. And today's data release showing the central bank's favored inflation measure pulling back for the first time since the pandemic. We begin with the big issue, a market that's questioning the Fed's credibility.
The market may indeed do some of the Fed's work for it.
It almost looked like yesterday that they cut because of that steepening.
We are seeing that Chair Warsh is contributing to volatility.
The rest of the market cannot play the ball without knowing how the Fed might play the ball.
This has become a lot more about credibility than actually bringing inflation down.
It occurred to me as I was watching the 10-year, the 30-year move that we were all effectively going through the 7 stages of grief.
If the longer end really starts to be properly unhinged, both 10s and 30s, I think that will be an issue.
Really, the market is trying to tell you that I think the direction of travel is going to be higher.
We probably have a rate hike coming.
I also think many people on the board are leaning towards a rate hike. Those dissents were not done in a vacuum.
Having dissents is not unusual. That being said, there's very little to hang your hat on in the market. 10-year rates really went up and down like a yo-yo.
Warsh keeps saying that he wants to hear from the bond market. So here's the bond market's response. We got a sharp sell-off in the 30-year Treasury that sent the long bond yield spiking. It topped 5.23% this morning. That's a 19-year high. And there was buying at the short end, the front end, leading to a drop in the 2-year yield, which, of course, is sensitive to Fed policy after the central bank did not deliver an immediate hike that the market had increasingly been pricing in over the last week or so. So we got a steepening of the yield curve. This is the 2s, 30s curve. And this move, by the way, was one of the biggest such moves after a Fed meeting since at least the mid-1990s. As for what the market is currently pricing in for the Fed going forward, pay attention to this yellow bar. That's for December, a 25 basis point rate increase for December. Now, Fed Chair Kevin Warsh remains elusive on the central bank's path for monetary policy, saying that the ball is in the market's court.
Market participants are learning to play the ball, not the referee. And market prices will continue to respond in the direction and magnitude they see fit. This is, in my view, a change for the better, and we're just getting started. After all, the central bank need not always and everywhere be the center of attention. I want to stress, of course, that decisions by this committee matter a great deal. And where necessary and appropriate, we will not hesitate to act.
All right, let's bring in Bloomberg's international economics and policy correspondent, Mike McKee, with more. He's got a chart in hand. And as I talk to you, Mike, we noticed that the U.S. mortgage rate has risen to 6.66%. This is the 30-year fixed rate mortgage, according to Freddie Mac. That is the highest level in a year. And we know the 10-year yield is what the Trump administration is laser focused on. Perhaps not as much the equity market, but really the bond market and the long end of the yield curve, the part of the curve that sets the rate for everything else for consumers.
Actions have consequences, and that's what's happening with the markets. It's not just a line on a screen, as you just showed. It's a real-life impact on consumers and the government. If you look at mortgage rates, they have gone up because the 10 years going up, and as you just mentioned, we hit the highest rate in a year. And up above is the average weighted interest rate for government treasuries. And as you can see, it has gone up over the past year. And I put in the dotted red line. Don't take that literally, but we're likely to see the government having to pay more now for interest. And this comes at the same time that Congress is working on a budget for next year that would raise the deficit maybe by as much as another $1 trillion. So at this point, what's happening in the markets, whether the Fed likes it or not, is having a real world impact.
Absolutely. I want to also ask you to fold in this morning's data. We got core PCE, which is the Fed's preferred inflation gauge, second quarter GDP, personal income, personal spending, core PCE coming down. or being held back a bit. Does that vindicate Kevin Warsh's stance?
Not really, because everybody knew what the numbers were going to be ahead of time. Once you get the CPI and PPI, economists can calculate within a basis point or 10 of where the PCE is going to come out, and they pretty much had it nailed, a little bit lower in the core. But what the problem is here is that the people who are dissenting and want to raise rates are not just looking at the month-to-month changes or where we are right now. They're looking at the fact that inflation hasn't come down for 5 years anywhere close to the Fed's target. And they think that even if we see a small drop, as we did this month, it doesn't bring us to what they have promised to do. So they think that we need to raise interest rates, even if inflation has come down a little bit. And that's going to be the debate going forward. We get 2 more PCE and CPI and PPI readings before the next meeting.
All right, Michael McKee, thank you so much. Our international economics and policy correspondent. He will be rejoining us later in the hour. In the meantime, let's get to our macro roundtable. I'm pleased to welcome back Ed Al-Hussainy. He's a portfolio manager for the Total Return Bond Fund at Columbia Threadneedle Investments. And Nicolo Bocchin. He is global co-head of fixed income at Azimut Group. He's normally based in Dubai, but here in New York. Welcome, gentlemen. So Kevin Warsh says he wants to get an unfiltered message from markets. He sees the markets as a very good source of information. Ed, I'll start with you. What is your interpretation of the message that the market is sending with this bear steepening of the yield curve?
Yeah, I mean, I think the key takeaway is the Fed delivered a dovish surprise relative to market expectations. And the market responded by putting in more inflation risk premium into the curve, particularly into the longer part of the curve. So, overall, the message is, one, it's a relatively steep learning curve for the chair. There's room to course correct, in the coming quarters. But it is a little bit of a concerning takeaway because the messaging from the Fed has been extraordinarily muddled.
Mm-hmm. And maybe some people say that's the way he wants it, this return to the Alan Greenspan days where you weren't quite sure what you got. Nicolò, how are you thinking about this?
I think you get zero communication, zero forward guidance from the Fed, simply because they want the market to start going its own way. So don't rely on the Fed, rely on your analysis, your modeling, your macro picture, and then try to translate that into yields, into calls on rates. Don't expect the Fed to tell you the direction, just look at the numbers and make your own assessment. As simple as that, and this makes absolutely sense.
So he's letting the market do the tightening. If outsourcing everything to the markets is kind of his MO, Nicolo, how far can the market go on this, the market tightening? How far does it go? And what's the fallout from that?
To me, there is a misinterpretation of the macro dynamics by the market at this point in time. So the market is not always correct about its assumption. And to me, at this point in time, is particularly wrong because there is a clear softening of the inflationary dynamics despite what is going on the oil price. Mm-hmm. But at the same time, there is also growth dynamics that are very stable, but on the back of meaningful CapEx expenditures by firms. This will not last forever. So the market now is pricing in on the long end a lot of term premium, a lot of inflation expectation, growth expectation, otherwise real yield wouldn't move so high. Mm-hmm. But at a point, the market, I think, will have to reassess this because we are coming from 2 years in a row with 2 shocks, the tariffs and the Middle East, and then both of them will clearly have a less negative impact going forward.
Ed, what's your take?
Yeah, I'll agree that there's tremendous value now in the yield curve in terms of forward-looking income from today's starting point. It looks pretty good. In terms of the Fed stepping away and allowing the markets to do their thing, there's the danger of kind of creating a hall of mirrors effect. The Fed has a mandate and a job to do. You've got to learn from the past. You have to interpret the present. You have to forecast the future. At the moment, the chair is refusing to do all three. You cannot step away from that responsibility. I think forever they'll have to come back and provide that information, at least in part, to markets. That's the anchor to the Treasury market at the end of the day.
Some people have called Kevin Warsh a dove in wolf's clothes, where he sounds hawkish, but he's not taking any action to kind of back that up. How long can he be hawkish without taking action, letting financial conditions tighten? And my question is, what happens, Ed, if inflation picks up during that time?
Yeah, I don't know. I have no idea what Kevin Warsh's position is because he's not shared it with us. I don't know if he's hawkish, he's dovish. I don't know his interpretation of the data. I don't know his theory of where this economy is likely to go. We are going to hear, I think, bits and pieces of that story from other members of the FOMC. We might not hear from the chair until perhaps later this year.
Right, he wouldn't even tip his hand about what he might talk about at Jackson Hole as well. Kevin Warsh seems to believe that the Fed can achieve its 2% inflation target, Nicolò, without overly damaging the U.S. economy or the labor market. Do you think 2% inflation is realistic without a recession?
Yes, but you need to take some time. So I think that the Fed did the right thing, not hiking rate, because these hikes, 2-3 quarters from now, would become cuts. So it's a disciplined approach to keep the rates where they are, because we all know that there is a bout of inflation now that, again, 6 months from now, 9 months, will be lower. So we are going toward the 2%. We don't need to hike rates now to cut them in 9 months' time. That's why I think they have this new approach. But you need to be clear on that. You need to communicate. So I agree 100% with Ed that you cannot just simply change your approach without talking about it.
There are also 3 dissenters in the policy decision at the Bank of England today, Nicolò, which shows that the BOE is just as divided as the Fed in many ways over policy. My question, though, is there just as much uncertainty and risk about policy, or is the BOE more clear than the Fed about its framework for thinking about and acting upon inflation?
I think they have the same approach as the Fed. They know that this inflation will be completely different a few quarters down the road. So again, it doesn't make any sense to hike rates 1 or 2 times now when you all know that these hikes will become cut. So, and then you are talking about a UK environment which is sort of different from a shape of the yield curve, from dynamics on the sovereign market.
Ed, Kevin Warsh talks about good family fights. I mean, that's one of his favorite phrases, and he contends that it leads to better policy. What does it mean for you as an investor? How are you making decisions? How are you changing your allocations, if at all?
Not really based on that characterization of the FOMC. Look, the FOMC is designed as a structure to have that debate. They're also designed to come to a conclusion and communicate that conclusion to markets and create the anchor, particularly in the front end of the curve. They're taking a little bit of a step back from that. Again, it's early days. I think there's lots of room to course correct. I think as an investor coming into this, you want to be a little bit more wary about the inflation risk they're introducing into the longer end of the curve. And so from our perspective, I think we are more wary of that duration risk further out. When you look at the intermediate part of the curve, I think it warehouses a combination of pretty attractive yields, very elevated from a real rate perspective, and I think still some degree of commitment that the Fed is going to put some work in to bring inflation down, or it might get very lucky with the data. Either way works in that intermediate part of the curve.
How about you, Nicolò?
I think there's a lot of value on the very long end of the curve because it's compensating for a lot of risk. The fact is that this source of inflation is completely different than 2022. This is an inflation that risks burdening and biting on the demand side. So if anything, my assumption is growth at that point, risk disappointing. That's why you want to extend duration by the very long end of yield curves. Maybe not really in the US, but if I look at a space like Japan, like UK, like Germany, to me is a really low-hanging fruits in fixed income.
All right, I think that's a good place to leave it, guys. Thank you so much. Ed Al-Hussainy of Columbia Threadneedle and Nicolo Bocchin of Azimut Group joining us here in studio. Still ahead on Bloomberg Real Yield, global return. The Bank of England, as we mentioned, holding rates steady, and Governor Andrew Bailey playing down the potential for future rate hikes. This is Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. We're stepping outside the U.S. for our global return. The Bank of England holding rates steady and pushing back against speculation of a hike, sending U.K. gilt yields slightly lower across the curve. Bloomberg's Francine Lacqua sat down with BOE Governor Andrew Bailey to discuss the decision.
There are two things I think that shape my thinking, certainly. One is obviously is the one that's shrouded in so much uncertainty. Is where are these events in the Gulf going to go to? And then the second question is, for any sort of given set of events, how are they going to feed through into domestic inflation? Now, we start in a position where it's come in lower than we thought it would. We're below where we thought we would be if you go back to April. But you can't take too strong a message from that in terms of second round effects going forwards, because frankly, this is a very unprecedented situation.
Governor, if you look at market bets, they reduced bets on a hike in September. We're now at around 33% chance. Yeah. Are you content with that?
I think the market pricing is sort of sensible.
So that's where you would lean towards.
The reason I say that is because when we survey the market, what the market tells us is that their sort of, if you like, their central expectation is for no change. But then they say, yeah, but there's a risk on the upside. And you can see that built into the market pricing. And I think that, as I said in the press conference earlier, I think that fits with the fact that we've got three scenarios. We've got less probability attached to any one of them, frankly, than we probably normally would. But the adverse scenario is further away from the centre than the lower scenario. And the adverse scenario basically is a scenario which says if this breakdown of the ceasefire continues as a permanent thing, then we're going to have higher energy prices, and that will have an effect.
But, Governor, we've also seen some new language, right? So the six members who held rates said the policy strategy could change if upside risks to inflation were to subside. So can you tell us a little bit more about that?
Yes. So I think if, however, we were in a position which we were when we started the meetings for this round, where the Memorandum of Understanding and the ceasefire was holding, and we had a crude oil price, I think, briefly down to somewhere not much above $70 a barrel. It's a bit higher than it was before the conflict, but not a lot higher. Then, yes, I think we're looking at a different situation. Now, sadly, of course, that hasn't held.
But that's very unpredictable at the moment, or yes. Are you expecting, so it could flip? And what happens if it flips from one to the other?
Well, I think there's two things going on. So if we got into a situation where the ceasefire is in place again, I don't think it's unreasonable to think that whether they come down as much, we'll see, but they come down again. But then the problem we've got is the sheer unpredictability of this, because this is what we've learned again in the last week, 2 weeks, 3 weeks.
Governor, your central projection shows unemployment peaking around 5.5% in 2027, a rate that we hadn't seen since 2015. A weaker labor market is helping, of course, to contain the second round inflation. Yeah. But at what point does it cost in terms of jobs?
Well, I think we are seeing softness in the labour market. We are seeing something of an output gap opening up, and that is reflected in the labour market. So I think it's exactly consistent with what you say is in the projections. Obviously, we don't want to see that happening. And one of the things I would say is that we don't have a dual mandate, and I like our mandate. What our mandate has in it, though, is what we call trade-off language, which is we've had another negative supply shock. Pushes prices up, activity down. Our job is to return inflation to target, but that language, that trade-off language, gives us some flexibility as over what period we return it to. We obviously have to look very carefully at things like inflation expectations, but it is in our mandate, and I think we must use that where we think it's appropriate to.
You've met with the new Chancellor. Do you think your mandate could change under this Prime Minister?
I've had no discussions on that at all, so I don't think that's anything that we should speculate about. I've not had that discussion.
I know you don't like talking about fiscal policy, but what does the uncertainty of the budget in autumn mean for the next couple of months?
Look, honestly, I don't go into this autumn in any different position than I normally do. Well, I know there's going to be a budget towards the end of the autumn, because that's the way the UK cycle works. And so we condition our monetary policy decisions on announced fiscal policy. We'll do the same again.
All right, Andrew Bailey, the BOE governor, speaking with Francine Lacqua. Joining us now from London is Morwenna Coniam. She is Bloomberg Markets Today editor. And Morena, there are 3 dissenters in this rate decision from the BOE, which is unusual in the U.S. because we also had 3 dissenters, but not so unusual in the U.K. What do we know about what those 6 officials who voted to stay on hold might need to see, would need to see in order to change their thinking for supporting a hike?
Yeah, so the focus really, as Andrew Bailey was just talking about, is on second round effects. And so that's seeing the initial impact of higher oil prices filtering through into wage setting and price setting as a consequence of that. And then it becomes more embedded. That's what we've seen previously in the past. And I think they still haven't really fully seen evidence of that. The other thing that they are concerned about was they don't have a dual mandate, as Bailey just said. They are concerned about the health of the economy. And when you have a sort of softening labour market, when you have quite anemic growth, that in itself contains some of the inflationary threat. And you have got tightening fiscal conditions purely because of those higher tightening expectations that we've seen over the past few months. So essentially, it's still wait and see and watching for a real sign that a hike is necessary when it is. The market is still pricing in a hike, this year, but that's now been pushed out to the very end of the year. Okay. So we have seen quite a paring back of that.
All right, Morena, thank you so much. Morena Kaniam is joining us from London. Thank you so much. Now, still ahead on Real Yield, our credit roundtable. We're going to speak with Winnie, Cisar, Global Head of Credit Strategy at CreditSights, and Bryan, Whalen, CIO and Generalist Portfolio Manager for Fixed Income at TCW. This is Bloomberg Real Yield. I'm Scarlett Fu, and this is Bloomberg Real Yield. It's time now for the auction block, where we highlight the major credit issuance so far this week. And we started in the U.S. with high grade. We are closing out a month that saw record issuance for July. This week, BlackRock led the way with a $12.5 billion sale tied to financing a Texas data center linked to Meta. Now let's dig into this BlackRock deal a little bit more. The bond offered a hefty yield of 7.53%. That's one of the highest levels for a blue chip data center debt offering. You see that here at the bottom of the chart. Demand for the deal peaked at just about $20 billion. That ranks as the lowest for an AI high-grade jumbo bond sale in the U.S. this year. And a new reverse Yankee bond sale shook up a quiet week in Europe. AT&T sold $5.3 billion in debt. This adds to the stampede of U.S. companies like Amazon and Alphabet seeking debt buyers in Europe, all part of an effort to diverse their funding sources and lock in lower yields compared to their home market. And sticking with credit, surging issuance from hyperscalers has some investors questioning where they can get the best return on investment.
The bigger issue for credit investors is that there's a lot of focus on the hyperscaler debt issuance, but there's a broad array of supply coming from the broader tech ecosystem. And so when investors are thinking about not just issuer concentration constraints, but how much exposure do they want in the credit market to the broader AI theme if they already have equities, that's what's causing, I think, the more careful consideration. The question for investors is, in our view, where specifically should you be taking this exposure and at what price?
All right, let's dig into all of this with our credit roundtable. Winnie, Cisar, Global Head of Credit Strategy at CreditSights, and Bryan, Whalen, Chief Investment Officer and Generalist Portfolio Manager for Fixed Income at TCW. I mentioned that BlackRock deal, a $12.5 billion bond at 7.53% yield, demand relatively tepid, about 1.6 times the deal size. Bryan, is this the start of an era of weak demand and much higher costs for corporate debt?
I think so. The short answer is yes, but I think let's focus on what's been causing this kind of softness in the corporate bond market, which is this tech supply. A lot of it being these large structured deals, $10 to $30 billion or more. Other being just traditional corporate bonds, but again coming from a lot of these hyperscalers. I think the point I would want to make here is that historically, when an issuer or a sector would come with a lot of debt, there would be kind of a natural circuit breaker, almost a feedback loop from the bond market to those issuers saying, all right, we've had enough. And because of that, we're going to raise your cost of borrowing. And that's going to effectively disincentivize you from borrowing. And then you kind of get more of a natural supply demand dynamic as things come into balance. This time around, you're talking about companies who are such believers in this AI trade and the data center need and the compute need. Like, they're thinking about tripling or quadrupling their equity value based upon this spend. And so whether they borrow at 6.5% or 7% or 8% in the corporate bond market, honestly, the math doesn't matter because of it's not the cost of the capital that it's only just getting the capital. And so, yeah, you know what? We'll pay an extra 100 basis points. We need that $50 billion because we're going to spend it on this data center, and that's going to contribute to enormous growth and value for our shareholders. And so there's this new insensitive borrower to price in the marketplace. And in the beginning, the market was able to absorb it because we're in higher yields and there's a lot of insurance money, et cetera, buying it. But at this point, it starts to feel like a point of saturation, but it also doesn't feel like this spend and this borrowing is going to slow down anytime soon.
So we have this interesting scenario here, an insensitive borrower, that is, and plenty of demand coming, plenty of supply coming out. Winnie, is there anything that you see that would disincentivize the tech companies from borrowing?
Yeah, I think that some of the points made there are just so top-notch, especially because these companies have been very highly rated, very cash flow generative, and also generally under-leveraged in their balance sheets. So there is a lot of room there. Now, there are some exceptions to that, with a handful of these issuers having a little bit lower rating, having a little bit of a track record of investors pushing back on some of the leveraging type activities that they've done in the past. And so I think that in order for there to be an incentive to perhaps balance capital structures a little bit more in the equity market, we might need to see the bond market get a little bit more punitive in terms of cost of borrowing. It's also hard to say, July is not typically the most liquid month across financial markets in general, and we've had some overhang from the macro. So it is a little bit difficult to discern, how much of the recent repricing is entirely due to the hyperscaler AI trend and how much of it is due to some of the other seasonal technical macro factors.
We just showed a chart on the credit default swap starting to widen out, showing the cost of insuring against corporate default is rising. And of course, this is a popular way for investors to hedge their exposure to this AI narrative. Bryan, what are the ripple effects of increases in these credit default swaps? Does it lead to higher borrowing costs for the companies, and then you kind of get this, self-fulfilling prophecy?
Yeah, I mean, I'm looking at your chart there. I would say, first of all, most, maybe the exception of one on here, and these hyperscalers have balance sheets that are some of the best in the world. They're kind of fortress-like balance sheets. They're rated AA, even though they've taken their combined kind of free cash flow from $250 billion a couple of years ago to zero or negative now as they're borrowing to invest this. They're still incredibly strong. So for most of those companies, even if this AI trade and spend gets disrupted or even kind of pauses, and we're not saying that, but even if it did happen, even though they borrowed this money, they're just going to go back to making gobbles of money and doing the other stuff they always do, and they're going to be just fine. So this is a dislocation. I think where what Winnie was probably alluding to, there are other companies, and there's a lot of them in this AI ecosystem, and we're not just talking about Microsoft or NVIDIA or Google. We're talking about companies that don't have that type of balance sheet profile. They're weaker. Some of them are high yield companies. They're levered balance sheets. And while they may be doing fine now, while they have a tailwind with regards to their business, not if it turns to a headwind, but that wind just kind of shuts down. There's a lot of connectedness in this ecosystem. And while the NVIDIAs and the Microsofts of the world are going to be just fine based upon their core businesses, these other companies might have a really hard time servicing their debt. And at that point in time, this kind of broad ecosystem, there might be much more interesting investment opportunities. We're going to be talking about things other than spreads and more about discounts and dollar price.
What kinds of companies are you hinting at, Bryan? Can you give us some names, or at least get a little bit more granular?
Yeah, we'll keep the individual exposure to names. We'll keep that for a one-on-one with you and I, Scarlett. I would just say, there's a lot of kind of smaller companies without the balance sheets, maybe kind of suppliers, maybe kind of smaller companies within the kind of the chip space that are reliant for their own funding, not just like on the debt markets that we're talking about today, but even just getting most of their financing and money from companies like NVIDIA or others. And if that tends to slow down or get shut off, they're going to have a real problem with their liability structure.
Winnie, a lot of what we're talking about when it comes to supply and demand are technical factors, supply overhang, wider spreads. What about the fundamentals? What kind of developments or even suggestive headlines at this point would cause a meaningful repricing or reallocation in the credit and equity market?
Yeah, I think what it ultimately comes down to is how much are we going to continue to see spend forecasts increase and kind of by default issuance forecasts increase. And then when do we start to see some of the monetization of this and return on investment? And that's especially important for some of these smaller companies that are a little bit more interconnected and dependent on the broader ecosystem succeeding. And, so far it's been, I would say, a little bit of a mixed bag this earnings season. And there has been a little bit of disappointment, even around earnings that have been, generally pretty strong. And so it does seem like expectations and reality are a little bit mismatched right now.
Bryan, in Europe and the U.S., investors are flocking to short-term credit to lock in elevated yields while longer durations have kind of struggled. Is this an effective way to get income while reducing some interest rate sensitivity?
Absolutely, especially today. I mean, yesterday we had a steepening in the yield curve, and all the news today and publications were kind of highlighting that. Although, that feels like, to be honest with you, like a lot of drama. It felt like yesterday's steepening of the curve was more about kind of positioning, and as Winnie was saying, kind of a slow summer, low volumes, kind of pushing things around. I think we all got to step back, and we're looking at the front end of the yield curve 40 basis points higher in yield relative to the long end of the yield curve. So year to date, despite yesterday's move, the front end of the yield curve looks more attractive today than the long end, while still producing, similar type of income levels. So the short answer to your question for your listeners and for investors out there is, yeah, I think the short end of the yield curve, whether you're expressing it through treasuries or high quality corporate bonds, looks like an attractive place to be.
Winnie, final question to you. Within this shorter duration, if that's what people are doing, is it worth moving down in quality and investment grade, going from AAA to AA or single A?
I think in some cases, yes, you still have to have credit selection at the forefront, especially given where we are kind of in the cycle and the AI cycle. There are definitely opportunities to add some alpha to portfolios by moving down the credit rating spectrum. We still like a lot of the high yield BB universe, but you are not necessarily getting compensated, like you once were from a spread perspective. It's become much more of that all-in yield dynamic.
All right. Thank you so much, guys. Really appreciate your joining us today for the Credit Roundtable. Winnie Cisar of CreditSights and Whalen of TCW in sunny California. And if you can't get enough talk on credit, be sure to check out the Bloomberg Credit Edge weekly podcast, available on the Bloomberg terminal and wherever you get your podcasts. Still ahead, President Trump has his eye on a new beautification project in Washington. This time it's at Dulles Airport. He wants to help the airport take off with a more than $20 billion makeover. That and more next in our Muni Moment. This is Real Yield. It's time now for our Muni Moment. President Trump announcing this week his latest makeover project for the nation's capital. He has got his eye on overhauling and expanding Washington Dulles International Airport.
Thank you for being here as we unveil exciting plans for a major and long overdue renovation and reconstruction of Washington's really horribly thought of Dulles International Airport.
Bloomberg's Ashna Shah joins us. She's been reporting on this story. And Ashna, this is a more than $20 billion overhaul of Dulles Airport. The obvious question is, how is it going to be financed?
Yeah, so a big portion of this project is going to be financed through the municipal bond market. It's a very common financing tool when it comes to airport renovation projects across the country. So the airport authority that owns and operates Dulles Airport will work with United Airlines and other airlines that operate out of Dulles, and they will come together to finance the renovations happening, to the concourses, the expansions to the facilities, and it'll come through the municipal bond market.
Right, and the airport already has a $7 billion capital plan, so they have some runway to get started at least. I feel like we talk about this quite often, airports needing to renovate. Dulles is not necessarily an outlier here, but the amount that we're talking about is quite substantial compared to some of the other airport renovation projects.
Yeah, I mean, 22 or over 20 billion is a huge number, but we're seeing those types of projects happen across the country. I mean, if you look at JFK, that's a $19 billion project that's happening. Yeah. That's a combination of municipal bonds, private, P3 projects, and so you have a combination of all these different financing tools to create these really big renovation projects, that's happening all the way from New York to San Francisco and LA. These airports are really old. They were decades and decades ago they were built, and so now they're coming up on capacity constraints. They're coming up on passengers just wanting a more luxury, premium experience, and so, these airports really do have to invest.
Everyone wants a lounge too, so I guess that's part of the renovation. So talk a little bit about the specific renovations that we're looking for at Washington Dulles.
So they're thinking of, replacing the C and D concourses. A big portion of it is also getting rid of the people mover. So they have like these mobile lounges that are basically like shuttle buses. They get passengers between different gates throughout the airport, trying to get rid of that. And then also Trump said he wants to build a United Polaris lounge there, which should be the biggest in the world.
Right. I noticed that Scott Kirby, the United CEO, was there at that announcement.
Yeah.
Ashna, thank you so much. Ashna Shah is one of our Bloomberg municipal reporters here. Staying with munis, let's take a look at the higher ed sector because Swarthmore College, a small liberal arts school near Philadelphia, just lost its AAA credit rating. Joining us now to report on that story is Bloomberg's Amanda Albright. And Amanda, this is S&P removing its AAA rating from Swarthmore, not anyone else. Am I correct?
That's correct. S&P took Swarthmore down just one level to AA+, so still a very strong credit rating. Swarthmore is still one of the most prestigious universities in the U.S. Its acceptance rate is below 8%, but really the issue that S&P flagged was with rising debt, and they made the point that the school is very much still in demand among undergraduate students, but the issue is really just debt that the college has taken on.
How much debt has it taken on?
So the school has about 500 million of munis outstanding, according to S&P. And so we saw them sell bonds last year as part of a few campus projects that they're undertaking. They've really kind of prided themselves on their very beautiful campus. They've renovated Martin Hall, which is kind of a campus hub. And they've also sought to become carbon neutral. So the school says that this is helping just kind of create more longevity with its buildings, which a lot of schools have identified as a priority because they want to make sure that when students visit that they're very impressed with the campus facilities and therefore want to attend.
Right, and want to apply and, of course, keep that admission rate low. Amanda, when we talk about companies or institutions getting a downgrade, the risk is that they might see higher borrowing costs as a result. Is that likely to happen here with Swarthmore?
I don't really see it as a risk with this situation just because the school is so highly rated and its endowment is approaching $3 billion. So investors will really look past this downgrade. A lot of them have their own internal rating systems. And I think that they're going to see, that acceptance rate, the number of applications, and kind of look past this downgrade.
All right. Amanda Albright, thank you so much. Bloomberg's Amanda Albright, one of our Muni reporters, and I meant to say acceptance rate, not admission rate. The acceptance rate is low. The admission rate is probably much higher than that. Still ahead, our final thought on real yield. The Fed holding rates steady, but not without what Kevin Warsh likes to call a family fight. This is Real Yield on Bloomberg.
I asked for a good family fight and I got one. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. That's the better way to get policy right. That's our North Star.
That was Federal Reserve Chair Kevin Warsh's comments on the family fight taking place among policymakers. He really likes that phrase a lot. What do you think he meant by it initially, and what do you think the market understands it to be now?
Well, I think what he meant was that he wanted an open, frank discussion where people would argue with each other. And to a certain extent, that happens now. Over the last few years, there's been criticisms from former Fed officials that it's gotten a little bit staged because of the fact that they have the transcript's out in 5 years. I'm not sure because I'm not invited into the meetings whether it's that or not. But the whole thing of a family fight and improving monetary policy doesn't make a lot of sense because it assumes that until Kevin Warsh got there, they didn't discuss any of this stuff.
And that's not the case.
And that's not the case. They've been talking about it for a long time. And a number of the things that his task force are looking at, data, he says the Fed should have more up-to-date data. He cites companies that put out data, Walmart, which has its sales data. But there are a lot of problems with that in terms of statistically adjusting the numbers so they make sense in a macro sense, and also with the fact that those companies charge a lot for it.
Yeah.
The Fed may be able to pay it, but the statistical agencies, the BEA and BLS, they've had to drop a number of those because they can't afford it. So unless Kevin's going to write a check, they're still going to have problems with that.
We also had 3 dissenters this time around. Is that unusual? I know that in the Bank of England, you often have 3 dissenters, and it's fine. No one reads too much into that. Should we be reading into this at the Fed?
I think people are reading too much into it this time. These are the same 3 that voted together in a dissent in April because they thought the Fed should take out the bias statement towards easing then. So it's not like this is a new position for them. And if you're just saying, well, the 3 of them voted to raise rates, well, that's a logical extension of what they had been saying all along. And a couple of them, Hammack and Logan, had actually said in the last couple of weeks we should be raising rates now. The fact that there is a contingent in the Fed that wants to raise rates is no secret, and there are many beyond those 3 who think that something needs to be done because we've been above the Fed's target for 5 years, and obviously what they're doing is not working. So I don't think there's a whole lot new in there for people to chew on, but that's what Kevin Warsh wanted. It's nothing new.
You look at the market reaction today, the day after the Fed decision, equities are flying high. And of course, there are specific reasons there when it comes to earnings, for instance. But the bond market is kind of extending, the confusion from yesterday. How would you read that? And what does that mean for what happens at Jackson Hole?
Well, I think there are 3 aspects to it. One is that the bond market is pricing in uncertainty now. So the term premium goes up at the longer end. Mm-hmm. The bond market is also concerned that maybe the Fed will be slower to raise interest rates. And then the third is that Congress is talking about a budget now that will add another $1 trillion to the debt. So there's a lot of reasons for the market to be skeptical about where rates should be.
All right, Michael McKee, as always, thank you so much. He is our international economics and policy correspondent. That does it for this hour of Real Yield from New York. Keep it here because we've got Balance of Power in Washington up next. But in the meantime, join us again next week, same time, same place. This is Bloomberg.